What frightening evil lurks in the hearts of college business students everywhere?
The Standard Deviants present The Wild and Wacky World of Finance. Starring Kalila Azrez, Jeremy Clavins, Gabrielle Smith, Dina Rubinson, Malcolm Smith, Herschel Bliefeld, Merritt Hicks, Brad Aldis, and Tessa Monroe.
Hi, I'm Tessa Monroe, and welcome to our Wild and Wacky World of Finance, Part 1. For the next 2 hours, we'll augment your learning of the basics of finance, including interest rates, financial statements, basic financial concepts such as risk, rates of return, and much, much more.
Included with your video are several inserts. These are important crib sheets with all the equations and tables you'll need to work along with us. They're not warranty cards, so don't throw them away. You'll need these.
Okay, here we go. It's disclaimer time. In order to fully understand the intricacies of finance, you have to go to class, read your book, and listen to your professor. So, do all that.
We present this finance course in the order of the table of contents, which you'll find on Insert Card 1. Also, please remember that this is not a live presentation. We're on video.
So not only can you watch from the comfort of your own room, but you can control the speed of the tape. You have the power to pause the tape, stop the tape, or just completely vegetate anytime you like. If you miss something, just back up the tape and try it again.
Introduction. The role of finance in the marketplace, accounting basics, and interest rates.
Let's start at the beginning of all discussions of finance.
We're talking the role of finance in the marketplace.
Finance.
Marketplace.
Finance in the marketplace.
Financial management is key to the success of a business. A financial manager has the difficult job of obtaining and using funds to maximize shareholder wealth. Much of what we'll do in the next 2 hours revolves around the financial manager's role in the business world.
3 main types of businesses exist in the marketplace: the sole proprietorship, the partnership, and the corporation. The 2 main concerns confronting the potential business owner when determining which form is best for them are taxes and personal liability.
The sole proprietorship is owned by a single person.
Hey there.
This makes it easy to form. The sole proprietorship is not considered a taxable entity on its own. The owner essentially is the company. In this form, no taxes are levied against the company itself, but instead, they are levied on the personal income taxes of the owner.
The partnership is when 2 or more people own a business without incorporating. Seymour and Chucky have just formed their own partnership to sell coiled plastic play toys to commuters. A partnership is easy to form and has a similar tax arrangement as the sole proprietorship because, just like the sole proprietorship, the partnership is not a separate taxable entity.
There are 2 main types of partnerships, general and limited. A general partnership is when each partner is involved in the day-to-day management and has unlimited liability for the debts incurred by the company. Limited partnerships, however, are a little different. In most limited partnerships, there is a limited partner who supplies the money and a general partner who supplies the expertise. Limited partners are liable only to their amount of investment in the partnership. However, their power in management of the company is also limited. In other words, in limited partnership arrangements, general partners run the show, just like you and your parents.
It must be said that these 2 formations have disadvantages in that, 1, it is tough to raise large amounts of funds or capital. 2, if the business fails, the sole proprietor and the general partner are personally liable for debts. And 3, it exists only if the owner does. If you die, the business entity dies with you.
Not only did he die, but so did the business entity.
The third type of business organization is called the corporation. The corporation as a form of business was created by a legislative act of the government as a separate legal body for the explicit purpose of conducting business. The owners of the corporation are the shareholders, or those who own stock in that corporation. How big your piece of ownership is depends on how many shares of stock you own. A corporation has most of the same responsibilities as an individual. It can sue and be sued, and is also taxed like an individual.
The advantages of the corporation are 1. No personal liability. The corporation itself can be sued, but not its individual investors. And 2. The ease of shifting ownership, which can be divided into stock and sold in public markets. And 3. The corporation lives on even after you don't. These factors all translate into an easier time for investors to raise capital.
We should have been a corporation! We should have been a corporation!
The major disadvantages of corporations are that they are more complicated to form and they are taxed separately by the government. This is known as the corporate income tax. The corporate income tax rate differs depending on the amount of corporate income and the whims of Congress. The corporate income tax basically results in a double taxation.
How's that? Because the business gets taxed and then the dividends or payments to owners of the company are taxed as income to individuals.
The same money is taxed twice.
Oh.
Let us walk you through an example of the double taxation that corporations unfortunately face.
Hey, my name is Dave Thompson, owner and operator of Tattoo U Incorporated, a national chain of tattoo parlors featuring excellent and courteous service, a sterile and clean environment, and the latest designs in tattoo formal wear.
For argument's sake, let's say that Tattoo U has been a big hit this year. It had a taxable income of $600,000. Let's also assume that the marginal corporate income tax rate for this year is 38%. Finance people call taxes marginal to kind of combine state and federal and everything else, so we do it too. So don't freak. 38% of Tattoo U's income is paid to Uncle Sam. Because the corporation is owned by many shareholders, those shareholders receive the financial return on their investment in the form of dividends. But this is where the double taxation comes in. Once those dividend payments are sent to the shareholders, they are taxed again by the government as personal income of the individual shareholders. So, first, the separate corporate legal entity of Tattoo U is taxed, and then its individual owners are taxed.
This compares to Our Heavenly Tattoo, a local tattoo parlor that is a sole proprietorship run and owned by Big Jimbo Floyd. Big Jimbo's income from Our Heavenly Tattoo is considered his personal income because his business is a sole proprietorship. So, the income from the business is added to Big Jimbo's income without a separate tax to Our Heavenly Tattoo. Jimbo is taxed at his individual income tax rate. He's only taxed once.
It must be said that although corporations do have disadvantages, most companies incorporate, unless they're very small. Why? Because it's easier to raise capital or funding for your business as a corporation. Raising capital as a sole proprietor or partnership is much more difficult. Also, investors in corporations have limited liability, meaning the most that they could lose is the amount they invested in the company's stock.
Now that we've seen what types of business forms we have to choose from, let's talk more about the role of the financial manager.
The overreaching, omnipresent, and all-powerful goal of the financial manager is to maximize stockholder wealth. Maximizing stockholder wealth must be at the forefront of all decisions made by the financial manager.
Hey Larry, you want to go get lunch?
The main factor for the financial manager to focus on in maximizing stockholder wealth is the earnings per share of stock, which is the revenue created by the company's operations, or net income, divided by the number of shares of stock. Earnings per share is very important to the determination of stock price. More earnings per share, more price.
The one thing a financial manager shouldn't do is create risk for the company. Hey, stop piling those oily rags over there. Risk in addition to fire hazards, is the chance that what we expect to happen really won't happen. Stockholders expect to make money.
Arrgh, where's my money?
I'm working on it.
Oh, okay.
The financial manager, that's me, must monitor the cash flows, increase earnings, and reduce risk.
Good afternoon, and welcome to the basics of Stock Price 101. Today we have a very special guest in class. Ladies and gentlemen, this is Alejandro, the financial manager. Alejandro, why don't you tell us a little bit about what you do?
I am the most important person in the company. The decisions that I make lead to the success or the failure of the company. I maximize stockholder wealth. Yes.
Well, Mr. Hondro, isn't it true that market forces have as much of an effect on stock prices as your actions do?
Well.
Hello, I am the New York stock market.
Kinda small, aren't you?
Low volume day. Anywho, stock prices are most greatly affected by the perceptions of investors. They're willing to pay more for a stock if they think it will earn them a lot of profit. Or if the stock has very little risk, if the company is not mired in debt, or if the company pays good dividends.
Where did you come from?
Behind the desk.
The Standard Deviants wish to inform you that though these are some of the factors involved in stock pricing, determining stock price is not an exact science.
Let's talk about dividend policy for a second. Corporate earnings are distributed to two areas, either to dividends or to retained earnings, or to both. Dividends are almost always actual cash distributions to shareholders. Retained earnings are earnings that are held by the corporation for investment in new projects and machinery. Good dividend policy has the best balance of dividends and retained earnings. Shareholders like the cash flow from dividends, but keeping enough funds to reinvest in the company increases the overall worth of the business by helping the business to grow, and also the stock value and dividend value to grow. In order for the business to grow, however, the financial manager must create the right balance in dividend policy and change that balance when the need arises.
Remember, market perceptions determine stock price. The goal of the financial manager is to do what you can to make your company and in turn your stock valuable.
So, taking all of the company's cash and disappearing into the streets of Rio de Janeiro would be bad.
The financial manager works in coordination with other executives and managers. Let's take a look at Alejandro's company, Woodlike Pencil Company.
As you can see, the hierarchy of a corporation begins with the board of directors. The board of directors is usually made up of the largest shareholders of the corporation, the heads of other corporations, and top chiefs of the company's management. The board of directors have final say in most of the important decisions to be made about the business. They are responsible to all of the shareholders at large who actually own the company. The board of directors needs to act in the shareholders' interest because if they don't, they'll be held accountable.
The president, or CEO, Chief Executive Officer, is named Nora. She's the person in charge of the management of the corporation and the reports to the board of directors. Although Nora runs the company, she must report to the board of directors.
The Chief Financial Officer, or CFO, is in charge of all financial management of the company, which includes both the Treasury and the Comptroller departments. The CFO usually reports to the CEO and is frequently on the board of directors. The Treasury deals with cash flows, who gets credit with the company, or big investments like acquisitions or purchases of new equipment and securities. The Comptroller does more of the hands-on type financial work, like accounting, payroll, and taxes. It must be said that this can differ from company to company.
At the same level as the CFO are the vice presidents of production and sales. The production VP is Philippa Hatches, and the sales VP is Fast Eddie.
So, which one is that financial manager dude we've been talking about?
This one. Sometimes the managers get a little distracted. They start to work in their own interest and not that of the shareholders. When the managers aren't working in the best interest of the company, we refer to the situation as agency problems. Two types of agency problems exist: stockholder manager and stockholder bondholder.
Stockholder-manager problems involve conflicts between the interests of the stockholders or owners and the managers, or those who run the company's operations. In some instances, managers do not act to maximize stockholder wealth. Instead, they focus on their own interests, like salaries, perks, and the corner offices of their positions, and therefore maximize their own personal wealth.
Okay, listen. There are a few things you can do to fix agency problems with managers. These are: 1. You offer stock incentives for certain goals being met by the company.
Oh yeah, there you go.
2. You threaten to fire the bomb.
Hey now, let's not get crazy.
3. A proxy fight. The stockholders can vote them out of office. And 4. The threat of hostile takeover.
Hoorah!
Option number 1, incentives. The shareholders need the management to act in their best interest by maximizing earnings per share of stock. How to do that? Offer the management stock. These deals are called stock options. Sometimes they're called ESOPs, which stands for employee stock options. The managers will act in the shareholders' best interest because increasing corporate wealth increases their own wealth.
Option number 2. Fire the bum. Does it get much more simple than that? If the manager isn't working in the interests of the shareholders, the board can fire them.
Number 3, proxy fight. The board can put the matter to the stockholders in a proxy fight. The stockholders can push the manager out of office by voting against them.
Option number 4. Threat of hostile takeover motivates managers to act in the interests of stockholders. Why? A hostile takeover is an unwanted move by an outside party to take over a corporation.
Can I yell surprise when we go in? No. Arg. Arg. Arg.
Oh no, this never would have happened if I'd worked in the best interest of the company and not my own.
Aye, your bumbling devalue this company made it ripe for a hostile takeover. Arg.
But I won't go down without a fight.
The other major agency problem is stockholder-bondholder. Why do these two groups' interests conflict? Bondholders are basically lending money to the company for a certain amount of interest. This is different from stockholders, who are purchasing a piece of ownership in the company. When bondholders decide to lend the money, they charge a certain amount based on the risk of the company. Less risk means the company has a better chance of being around later to pay the money back. Bondholders hate risk because risk decreases the value of the bond.
Most bonds have neat little agreements to protect the bondholders. They force the company to do certain things to avoid risk. It's kind of like when you get a credit card and sign the agreement to pay everything back on time.
Being a stockholder, I like risk more than bondholders do because it can dramatically increase my earnings. You can generally assume that companies and investors like me only accept risk if it can lead to very lucrative returns.
Financial managers must balance this agency problem properly to maintain access to the money of potential bondholders while still pleasing their stockholders.
Different
Types of markets.
Different types of markets.
In a basic sense, a market is anywhere money, goods, or services are exchanged.
The market in which the money is invested depends on the length of time you wish to invest. Investments in securities that last less than a year are called money market investments. Longer investments are dealt with on capital markets.
You'll also hear the terms primary and secondary markets. The actual distinctions between them are kind of shady, so just remember the difference this way. Primary markets are the place where new securities are sold. Secondary markets are where used securities are sold. Technically, this isn't quite right, but as far as we're concerned, that's how things work.
Academic disclaimer. Primary issues are when the company first sells the securities. Secondary markets are where most securities are traded. These are the big, organized markets that most investors use, like the New York Stock Exchange.
But wait, there are even more kinds of markets. This goes fast, so be ready to rewind.
Credit markets are the ones that deal with small-time loans, like the kind you take to pay for school, cars, and wedding rings.
Mortgage markets deal with loans that use real estate as collateral, like mortgages.
financial asset markets are what we've been dealing with already. Stocks, bonds, the like. Interestingly enough, this is the financial community's favorite type of market. So, when they really like something, they call it by the abbreviation FAM. Hey Ken, how was lunch? A broker will say to another. Thanks for asking, he'll say. It was really FAM.
There are a few more markets you should be familiar with. Ready?
Farmer's market.
Fish market.
Flea market.
Black market.
Parkin' market.
Meat market.
Section C, financial statements.
Financial statements show you the essence of a company's financial standing. Finance is about money from companies, and financial statements give the details. Almost all financial statements are based on the T account.
The T account.
The T account is a form of the accounting equation that states that assets are equal to liabilities plus capital or owner's equity.
Assets are all the chunks of property that the company actually owns. Liabilities are all the things that the company owes to someone else, including the money they owe to bondholders. Equity and capital are pretty much the same thing. Either the money that the company has sitting around waiting to be invested, or the amount of money stockholders have invested in the company.
It's all in accounting, people!
Remember, the left side equals assets, and the right side equals liabilities and equity.
One of the most important chunks of financial data is the annual report. The annual report is based on the T account, and it's basically an in-depth version of it.
Of all the reports and papers that companies produce for external use, the annual report is the most important.
It's the Bible of all reports, the mother of all reports, the king of all reports.
The financial manager, that would be me, prepares this report for the corporation's stockholders. It includes all of the company's yearly financial information, the officer's commentary on the year's results, and a forecast of the future earnings potential. The main part of the annual report is the balance sheet, which explains nearly everything about a company's assets, liabilities, and equity in almost no time.
Let's walk you through a company's balance sheet.
The company is called Naked Trampolining. They are cashing in on the wave of trampolining crossing these United States, and are adding a new twist to this unusual sport: baby oil.
So, for Naked Trampolining Incorporated, we see that they have total assets of $100,000 and total liabilities and equity of $100,000, because liabilities and equity must equal assets. Notice that assets are made up of cash on hand, inventory, which would be the current stockpile of trampolines and baby oil, which they've not sold, accounts receivable, which is money that they're owed by folks who bought baby oil, as in the product is bought, just not paid for yet, and plant and equipment, or the fixed costs which they incur for the equipment to build the trampolines. This adds up to total assets of $100,000.
The liabilities and equity consist of 1. Accounts payable, bills and other monies owed, and other liabilities, which include the long-term bonds the company has issued. 2. Stock. There are 2 basic classes of stocks, but we'll discuss that later. And 3. Retained earnings. Retained earnings are portions of money earned that the company keeps and invests instead of paying out to the investors of the company as dividends. Remember, bonds and stocks are on the right-hand side. Common stock is the equity ownership of the company. There are 2 forms of stock, common and preferred. Common stock is the most common form of stock.
Common stock represents a piece of ownership in a company. Common stock includes full voting rights to elect the board of directors. Common stockholders also receive dividends, which are big or small, depending on how well the company is doing and how much the company is giving out in dividends instead of reinvesting.
Preferred stockholders don't get to vote. They just buy the stock and get dividends, which they get before everyone else. They get the same dividend every period for as long as they hold the stock. Dull, but predictable. And safe.
The net worth of the company is also known as the common stockholders' equity. In an accounting sense, common stockholders' equity equals assets minus the liabilities minus the preferred stock.
Okay, enough about stocks. Let's get back to the annual report.
Although the annual report often includes many financial statements and summaries, the two most important are the balance sheet and the income statement. These two crucial financial statements appear in all annual reports and provide important information for the potential investors looking at the company or to those who have already invested and are evaluating the company's performance.
Let's examine the income statement.
The income statement reviews the company's receipts, or revenue, and its expenses over the past year. The income statement begins at the top with gross income, or the company's total revenue. Next come the operating expenses.
After the operating expenses comes another tricky expense called depreciation. Depreciation represents the wear and tear on your equipment, which causes it to decline in value over time. So, while the company may have machines that they bought for $50,000, the machines may only be worth $45,000. Big deal, right?
Wrong. The government taxes the company on its income. The wear and tear on the equipment reduces income. So we estimate a value of depreciation, which causes the amount of income subject to taxes to be reduced. However, after income taxes are calculated, the depreciation is added back to the net income because it's just a loss on paper, not an actual cash loss. See, here's where we subtracted depreciation for naked trampolining. And then here's where we put it back.
Tax.
Spend.
Tax.
Spend.
Tax.
Spend.
Gross or total income minus all expenses and depreciation equals earnings before interest and taxes, known as EBIT.
Ribbit.
So, you can see what is subtracted next. Interest on debt. Once interest is subtracted, you are left with EBT, earnings before taxes. Then Uncle Sam takes his portion. There, you have net income. Now, you add depreciation back in. You do that because you never really lost the depreciation money. You just reduced your income on paper and tax liability. I mean, it's not like you wrote a check to the depreciation fairy.
If you need to know more about accounting or have never even heard of this stuff, a good place to go is back to the bookstore. There, you can pick up the Standard Deviant's Guide to the Shocking World of Accounting.
Okay, let's move on to Section D. Interest rates. A critical concept in finance.
And in the concept of love.
What makes up an interest rate? Why does a treasury bond give 6% interest instead of 2% or 19%? Why do interest rates differ between different financial instruments?
Well, interest rates are made up of several components. You can see the different parts next.
K is the symbol we use to stand for the quoted market rate of interest for a given security. This quoted rate is determined by combining three components: the real rate, the inflation premium, and the risk premium.
Yeah, well, let's see you build an interest rate. Okay, so let's build an interest rate.
Okay.
The first component of interest rates is the real rate, symbolized by K star. The real rate is the interest rate on a riskless security, not including inflation. You know, a stock or bond that would always return what the seller claimed it would. Coincidentally, this rate is based on a U.S. Treasury security because the government is assumed to be risk-free.
New from K-Star Records, finance's greatest hits.
You don't pay me annuities anymore. The second component is the inflation premium, symbolized by IP. Because prices rise, an extra premium is added to the interest rate to account for inflation. Thus, inflation premium. Combining the first two components, real rate of return plus inflation premium, gives you what is called the risk-free rate. The only security that can have an interest rate equal to the risk-free rate is a U.S. Treasury bill, or T-bill. It is riskless because the government won't fold or fail like a company can. However, even a T-bill is subject to inflation, and it does have some trouble getting on buses.
Treasury securities come in three types: bill, note, and bond. The difference is in the maturity. A T-bill is U.S. debt security that matures a year or less after it is issued. A T-note takes between 1 and 10 years, and a T-bond has over 10 years till maturity.
The third and final component of interest rates is the risk premium, or RP.
This component is added to the inflation premium and the real rate of return to compensate for the risk of investing in a corporation. The risk premium changes depending on the amount of risk. So, the interest rate on a bond issued by General Electric would have a lower risk premium than a bond issued by the Tattoo U chain, because Tattoo U is an unproven company, whereas GE is both proven and profitable. And brings good things to life.
Let's sum up this whole mess with interest rates. Interest rates on corporate bonds are composed of the real rate of return, the inflation premium, and the risk premium. These all add up to the quoted interest rate for a given bond. The only investments without a risk premium are Treasury securities because they are guaranteed by the full faith and credit of the U.S. government.
Ladies and gentlemen, the President of the United States.
Thank you. Thank you very much for coming. I want to assure everyone that Treasury securities are guaranteed by the full faith and credit of the United States government. Yes, Jim.
Mr. President, what are you planning to do to make this skit funnier?
I'm going to drop my pants.
Another topic for discussion in this section is the relationship between long-term and short-term interest rates. This is called the term structure of interest rates.
First, in order to visualize the relationship, you need to understand what's called a yield curve. The yield curve shows the relationships between the interest rates and the time to maturity of securities.
For example, this yield curve shows the yield for U.S. Treasury securities on November 10, 1996. On the y-axis, vertically, are interest rates. Horizontally, on the x-axis, is the length of time to maturity. For Treasury securities as shown here, the short-term rates are low and increase as the time to maturity increases.
This graph is called the yield curve. It enables the financial manager to visualize the yield or interest rate of a particular security based on that security's maturity.
Most of history shows that long-term rates are most often greater than short-term rates, and therefore producing an upward sloping yield curve. When the yield curve is upward sloping, it's called a normal yield curve. This is a normal yield curve. As I'm sure you remember, the interest rate on Treasury securities is equal to the risk-free rate because they are backed by the U.S. government. Let's compare the yield curves for Treasury securities to the yield curves for two of our hypothetical companies.
As you can see by this comparison of Treasury securities to the current yields for Tattoo U, Tattoo U's interest rate is higher than the Treasury's. Why? Because even though Tattoo U is somewhat reliable, it is still riskier than the Treasury securities, and its interest rate, therefore, includes a risk premium over Treasury securities.
If we compare both the Treasury securities and Tattoo U's to Naked Trampolining, Naked's yield is much higher than both, because the risk is much higher on an upstart like Naked Trampolining. The greater the risk, the greater the interest rate necessary to attract investors.
By the way, sometimes, though not very often, short-term rates are higher than long-term rates. When that happens, the curve looks like this.
Let's summarize a little of what we have already heard. We learned that there are three main types of businesses: the sole proprietorship, the partnership, and the corporation. Taxes and liability are two main concerns in choosing which formation, as is the ability to raise capital. The overall goal of the financial manager and the company is to maximize shareholder wealth. This is done by focusing on earnings per share. We also learned that the annual report is an important document which investors use to evaluate companies. The two most important statements that the annual report often includes are the balance sheet and the income statement. We learned about the components of interest rates, including the real rate, the inflation premium, and the risk premium. Finally, we learned about the term structure of interest rates, which is the relationship between long-term rates and short-term rates. Now it's time to move on. Part 2, the time value of money, or lots of equations that can tell you things you didn't already know.
We are now going to discuss the time value of money. In essence, we are talking about how the value of money changes with time. Money does have a time value to it. $100 today is worth much more than $100 10 years from now. This concept dramatically affects the actions of the financial manager and figures into most computations. Time value of money is as important to the financial manager as cocoa butter is to bodybuilders.
The first important concept in time value of money is future value. Section A, future value.
Future value is the amount that a present sum of money will grow to in the future when compounded by an interest rate. First, let's talk about compounding interest. This is a very simple concept, and those of you out there that have credit cards and are using them way too much have experienced this before.
So if you're using your credit cards, the credit company is compounding your interest every day. Compounding is adding interest to a balance or the principal at certain regular intervals. It is essentially starting with a present value or a sum of money today and determining a future value of that money by adding an interest charge to it. An easy example of future value is you depositing $10,000 in your savings account, which I'm sure happens all the time. It has an interest rate of 8% a year. In a year, that $10,000 will be worth $10,800. The future value of that money when put in a savings account is $10,800 or $800 greater than the present value.
Let's look at it from a debt perspective, which, if you're anything like me, I'm sure you're familiar with. Let's say you spent $5,000 on your credit card in a local mall. You spent to the $5,000 limit all in one day. Let's say this card compounds your interest at 15% once a year. Although most credit card companies compound at a daily rate or monthly rate, for the sake of this example, let's say it's yearly. So you've spent $5,000 on goodies at a yearly rate of 15%. At the end of the year, you would owe $5,750. You're paying $750 in interest for that year on a principal of $5,000.
The three main terms here are 1, principal, which is the amount borrowed or invested now. 2, time period, which is the length that the interest will be paid or owed. And 3, the interest, which is the amount paid for the use of the money. Hey, we're talking about credit cards here. Why are you dancing? Force of habit, I guess. Freaky.
Most of the time, the interest rate is not as simple as merely adding the interest to the balance once, or compounding it once. Most of the time, interest is compounded at regular intervals, and then you also pay interest on the interest that was added to the balance during the last period. Compounded interest means more dough for the person receiving the interest. Compounding is interest on interest.
So if you were putting $2,000 in the bank, and you were getting 10% interest compounded yearly, and you left it in for 3 years, how much would you have at the end of the third year? Remember, interest is compounded on interest after the first year. Let's figure it out. $2,000 times 10% for the first year equals $200. $2,000 plus $200 equals $2,200. Then you compound $2,200 at 10% for the second year. $2,200 times 10% equals $220. $2,200 plus $220 equals $2,420. Then you compound $2,420 at 10% for the third and final year. $2,420 times 10% equals $242. $2,420 plus $242 for the third and final year equals $2,662. The future value of $2,000 in the bank for 3 years compounded yearly equals $2,662. So you would make $662.
Woo! Pretty exhausting, huh? Don't you think there's an easier way?
You bet there's an easier way. We now have a wonderful formula for you on future value, which you will find much easier to cope with.
I can't sleep. I keep having horrible headaches all the time from trying to figure out future values.
You don't have to do it the hard way. Try this.
FV equals PV times the quantity 1 plus I raised to the power of n.
It's the best way to figure future value of lump sum.
FV equals PV times the quantity 1 plus I raised to the power of n. It works for you.
FV, future value, is equal to PV, present value, times 1 plus I, the interest rate, raised to the power of n, the number of periods. Essentially, this equation just adds the interest for each period to the balance before compounding that interest again for the next period. Some genius came up with the 1 plus I to the n part, so you don't have to add every compounding period. With this equation, you could find out the return on your investment after 3 periods. Let's try it.
You invest $2,000. You have a 10% interest rate. We're going to change that 10% to a decimal. We always do that, so don't freak. Future value equals present value of $2,000 times the quantity of 1 plus 0.10 interest to the third, representing 3 periods. $2,000 times 1.331 equals $2,662.
The future value of your investment after 3 compounding periods would be $2,662 at 10% interest. Not bad, eh? For a formula, it beats the hell out of calculating how much interest you will earn, and then adding that to the principal balance, and then calculating again and repeating for all time periods. So remember to use the easy formula and not do it the hard way like we did before. If any of you are wondering how we got this formula, we'll address that now. Someone else figured it out. Where it came from is not important. You know how to plug in the numbers and get the answers you want, so don't make waves. The 1 plus I to the n part of the formula is called the future value interest factor, or FVIF.
FVIF.
This value allows for a much easier time in determining future value of a principal with compounding interest. You can use a calculator to figure out the future value interest factor.
Or you can use this table. I'm sorry, I mean this table. Table Uno we have included at no extra cost.
To use the table, just locate the interest rate along the top and the number of periods along the left side. Then you've got your FVIF.
FVIF!
Once you have your FVIF, all you do is multiply it times your present value, giving you your future value for an investment for a certain number of periods. The FVIF and Table Uno make computing future value much easier.
You must remember that the compounding period may not always be a year. Interest can be compounded annually, semi-annually, quarterly, or in the case of your credit card, daily. As a matter of fact, many financial institutions compound their interest in some other form than annually. So, let's talk about this for a minute, because the compounding period can have a serious effect on the future value of your investment.
Hourly interest. The golden rule for you to follow is, the more frequently you compound interest, the greater the future value. This makes sense. Every time you compound interest, you are adding more to the principal balance, which the next compounding period will be based on. Let's say a $100 investment is compounded semi-annually. That means twice a year. It is compounded once at mid-year and then again at the end of the year. But the mid-year interest is added to the principal balance, and that year-end interest calculation is based on both the principal and mid-year interest.
We do have a formula to reflect different compounding scenarios. Take the future value formula, which we've just discussed, and use the chart for future value, Table Uno. You would look at Table Uno for the future value interest factor. Now that we're talking about compounding twice a year instead of annually, there are double the amount of periods and half the amount of interest per period. If you had an investment with a present value of $100 and it compounded semi-annually for a total of 10 years at a 10% annual rate, that would mean you actually have
20 periods of compounding at 5% per period. When you fill in the formula, you must count the number of periods, not number of years, and apply the appropriate interest per period.
So let's follow the example through. You put $100 in a savings account for 10 years. It will compound semi-annually at a 10% annual rate. So the future value of this investment is equal to the $100 present value multiplied by the FVIF.
FVIF!
The FVIF is measured in interest per period. In 10 years, there are 20 periods if it's compounded semi-annually. And if the annual rate is 10% per year, you have a 5% rate per period because there's 2 periods in every year. So, look at Table Uno and find where the 20th period and 5% interest meet. They meet at 2.653. Multiply 2.653 times the present value. You get 265.30.
Hey, anybody want to see my nipple?
Now compare this to the same amount of investment, $100, but compounded annually. You get a FVIF of 2.594 and multiply that by the $100 for a total future value of 259.40. As you can see, the more compounding periods, the greater the future value. Because there are more compounding periods, interest is compounded on interest more quickly.
Because of the effects of the differences in compounding rates, we need to talk a little about the different types of rates often used in the marketplace. Financial institutions have many different names and types of rates that they charge. We'll come back to this concept later in the video after we finish present value and annuities. All right? Okay, I'm going to book. Section B, the future value of an annuity.
Now let's talk about annuities. Isn't that a fun word? Go ahead, try it. Annuity. Pretty fun. An annuity is a stream of equal payments made over a certain time period at fixed intervals. There are 2 main types. Ordinary, which most annuities are, or an annuity due, which I happen to have.
Early in the spring, the annuity dew gathers on small shrubs and grasses.
I know, that's not what an annuity due is. The difference between a regular annuity and an annuity due is when the payment is received. An ordinary annuity's payment is received at the end of each period. That's why they're also known as deferred annuities. An annuity due's payment is received at the beginning of a period. These are much less common. In the business world, the annuity due is extremely rare. Let's show them how to value annuities.
Give me the money. Now get out of here. An example of an ordinary annuity is easy. Let's say you are becoming stingy as you begin college, which is not likely, and you want to save a little money, not likely either. You were saving up for that hedonistic senior year trip to Barbados.
You decide to take out $600 of spending money at the end of every year and put it in savings. The stream of payments to the savings account is an annuity because you're making fixed payments of $600 at regular intervals once a year. This savings account earns 6% interest annually, and you will do this for the 5 years you will be in college. So that's $600 every year over 5 years at 6% interest. You can see that this is an annuity because you are making the same payment, $600, in fixed intervals at the end of every year. When you graduate, hopefully after 5 years, what is the future value of your annuity of $600?
Each deposit payment gets compounded by the bank each year until graduation, but the number of times each deposit is compounded depends on the year it was deposited. The first deposit would be compounded 4 times, once for each year remaining until the end of the annuity. So, the second payment gets compounded 3 times, the third 2 times, and so on. The total value of the annuity is the sum of all the compounded payments. So, $600 at the end of freshman year compounded for 4 years, plus $600 at the end of sophomore year, compounded 3 years, plus $600 junior year, compounded twice, plus another $600 senior year, compounded once, plus that last $600 in your 5th year. The compounding is 1 less than the number of years because the deposits are made at the end of the year. And so the deposits don't get compounded the year they're put into the account. Anyway, you can probably tell that this way, calculating annuities is a real pain in the butt.
However, brilliant financial analysts created charts, like we saw before, to avoid all of that work.
You have got to be kidding.
So, once again, instead of figuring out the compounding interest for each payment and then adding, we can use a different table. Table DOS. To get the future value interest factor of an annuity, or FVIFA.
FVIFA.
And multiply the FVIFA by the amount of the payment, or pay. That gives you the future value of the annuity.
In our example, we would go to Table DOS and look for the interest rate of 6% and the number of periods, once again stated annually, so a period equals 1 year, and find 5 for 5 years. 5 years and 6% intersect at 5.637. This is the FVIFA, the future value interest factor of an annuity. Then we take the FVIFA and multiply it by the payment of $600.
At graduation, you will have $3,382.20. That's the future value of your annuity of $600 a year, which you deposited for 5 years. And you're off to Barbados.
Hey, want to see my nipples?
Yes!
As we said before, there is another type of annuity, the annuity due. The only difference here is that the payment, or in our example the deposit, is made at the beginning of the year rather than at the end. So this student would deposit the cash in January instead of December. Since it is in the bank earlier, you must add one more interest payment to the mix. Everything gets compounded once more. So in terms of the formula, the future value of an annuity due equals the original payment times the future value interest factor times one more period of compounding, or 1 plus the interest rate. In our student's case, 600 times 5.637, which is the FVIFA, times 1.06, one more interest rate compounding. You have one more period of compounding because this is an annuity due. This student's deposit now equals $3,585.13.
So with an annuity due, this brain earns more money. He's got even more money for Barbados.
So remember, with an annuity due, payments are made at the beginning of the period, so they get compounded one more time. Regular or deferred annuities pay out at the end of the period.
So far, we have talked about compounding interest, future value, the future value interest factor, or FVIF.
FVIF.
The ordinary annuity and the annuity due. We also learned how to compute the future value of an annuity using the future value interest factor of an annuity, or FVIFA.
FVIFA.
Remember, future value is a tool you use to find out how many dollars you'll have in the future.
Now, it is time to move to present value. A different concept, but still pretty much the same.
Section C, present value. Cuckoo Kajou.
Present value is the next tool you will need to decipher the mysteries of finance. Money in the future can buy fewer things than it can now. If you don't believe this, just go talk to your grandparents.
Oh, when I was your age, $100 could buy a house and everything you needed to build it.
Grandma, I'm over here.
I'm not talking to you. I'm talking to the television. The television loves me. It doesn't show up just on holidays or when it needs to borrow money.
Present value allows you to adjust for the devaluation of money over time. Present value gives you the value of some future sum in present-day dollars. This can be kind of confusing, so we'll try to say it another way. If you know how many dollars you'll have in the future, present value can tell you how much they would buy today.
So you can see, Future and present value are very different concepts. Unfortunately, they're related mathematically. Present value is the inverse of future value. Future value compounds by an interest rate. Present value discounts by an interest rate. Present value essentially takes away the interest.
Just as we saw 1 plus I to the nth equals the future value interest factor, the 1 over 1 plus interest to the number of periods is known as the present value interest factor, or PVIF. Once again, instead of doing this calculation, you can use table number 3. We call it table tray. You use this table just like the others, with the interest rate on the top and the number of periods along the side. You now take the PVIF and multiply it by the future value, and the result is present value.
Because present value takes away the interest, it's also useful when you know how many dollars you want in the future, and you know what the interest rate is, but you don't know how many dollars to invest.
Here's an example for you. Let's say you want to have $100,000 in 10 years to purchase a ship. You found a good investment will give you a return of 10%. How much do you need to invest today to make the $100,000 in 10 years? What you're really going to find is the present value of the $100,000 in 10 years discounted at 10%. Let's stick the numbers in the formula. Present value equals future value times the PVIF.
With the numbers plugged into our formula, present value equals 100,000 times the PVIF of 10% interest and 10 periods. 100,000 times 0.3855. We know this by looking at our handy table trace for 10th period and 10% interest. 100,000 times 0.3855 equals $38,550.
You would have to invest $38,550 in that security for 10 years at a 10% interest rate to make $100,000. $38,550 is the present value, or the value today.
Present value is an extremely important tool for financial managers, for it allows them to determine what an investment's value is now based on its cash flow projections.
One other term is used frequently with present value: opportunity cost of money. We call it the opportunity cost rate. The opportunity cost rate is an easy concept. It's the rate of return for an alternative investment of similar risk. This is used by the financial manager as a method of comparing the expected returns or discount rates of projects.
Section D, the present value of an annuity.
Whack, whack. An annuity is a steady stream of payments for a given period of time. Annuities are nice to have, but because of the time value of money, each subsequent payment of an annuity is worth less. By figuring out the present value of an annuity, you can find out how much all the payments are worth in today's dollars. I'm sure by now you're used to the magic of our tables, so go to the last one now. This is your final table, Table Quattro. This table lists the present value interest factor of an annuity, or PVIFA.
A good example of an annuity is the lottery. Let's say you won. You hit the big one, $10 million, which entitles you to $500,000 a year for 20 years.
Party!
What's the present value of that annuity payment? If someone wanted to buy that ticket from you today, how much should you ask for it?
I don't know.
They tell you $10 million. But what is it actually when you take into account the time value of money?
$1 billion.
No. So anyway, today's going interest rate, or discount rate in this case, is about 8%. So figure it out.
Do I have to?
Don't make me come over there.
Okay.
First, look at Table Quattro. To get the PVIFA, find the number of periods, 20, for 20 years, and find the discount rate, 8%. They come together at a PVIFA of 9.8181. Then multiply 9.8181 times $500,000, or the annuity payment. You get $4,909,050, or $4.9 million. So the present value of that lottery win is $4.9 million. That's a big difference to $10 million. And $4.9 million is before taxes.
You might remember that when we were discussing the future value of an annuity, we also discussed annuities due. Remember that the only difference between an annuity due and an ordinary annuity is that an annuity due's payment happens at the beginning of the time period. So, to compute the present value of an annuity due, you must make a similar adjustment like we did for the future value of an annuity due.
Annuities due are paid at the beginning of the period, so they don't get a chance to get compounded as much as the regular annuity. So when calculating the present value of an annuity, you have to adjust for the last lack of compounding by discounting it one less time. To do this, you multiply by 1 plus I. Don't ask why, just accept.
The present value of the annuity due is the payment per period, multiplied by the PVIFA for the interest rate and the number of periods, multiplied by 1 plus the interest rate. So for our example, we have the annual payment, which is now made on January 1st. 500,000 multiplied by the PVIFA for 8% and 20 periods. It's the same as in the previous example, 9.8181. Then we multiply that by 1 plus the interest rate, or 1 plus 0.08. Simplify that a little. Now we have 500,000 times 9.8181 times 1.08. Multiply. The answer now is 5,301,774.
Why is the annuity due's present value greater than the ordinary annuity? Because the annuity due is paid at the beginning of the time periods. This causes it to be discounted one less time, just as the future value of an annuity due is compounded one more time. The annuity due causes the present and future values to go up. So although an annuity due is not as common, it is more valuable if you are receiving the income from an annuity.
Remember that an annuity due is very rare.
Section E, perpetuities. Let's continue on in the wonderful world of annuities. There's one kind of annuity that everyone would love to receive. It's an annuity that never ends.
Never?
Never.
Ever?
Ever.
Never, ever?
Okay, shut up.
An annuity with a constant stream of never-ending fixed payments is called a perpetuity.
To help you remember, think perpetual when you think perpetuity.
Let's say that you have just discovered that you have a distant great-great-uncle in Lithuania whom you have never met. His name is Josef Stolichnaya. Uncle Stoli, who is quite proud of you, is an old man who made millions of dollars selling horse apples to the spud farmers. One afternoon, your kind-hearted Uncle Stoli has a triple aneurysm in his home. The will is read, and you are the sole heir to the horse apple dynasty. You get a call one day from a lawyer who is butchering the English language.
Hello?
Hello, old bean. I have some smashing news.
I can't understand a thing you were saying.
The lawyer tells you that your distant Uncle Stoli, whom you didn't even know, has left you as sole heir to the horse apple dynasty. Included in the will is a payment to you of 250,000 American dollars every year until you die.
Thanks, Uncle Stoli!
Hey, no problem.
Let's figure out the value of this perpetuity. The payment is $250,000 a year, and the current interest rate is 10%. To set that up, we see the present value of the perpetuity is equal to the payment, $250,000, divided by the interest rate, 10%. That equals $2.5 million, the present value of the perpetuity.
To determine the present value of a perpetuity, you divide the payment by the interest rate or discount rate. Because a perpetuity is a fixed payment, the present value of the perpetuity depends on the going discount rate, because the payment stays the same regardless of what happens to interest rates. If the discount rate goes up, the present value of a perpetuity goes down, and vice versa.
Higher interest rates mean you discount the value of the perpetuity more.
So throughout all this, we've been saying that money is worth less in the future. And we showed you how to use all kinds of tools that work on that principle. But we're sure you're still wondering, why? The whole idea is that everybody else out there, from investors to your mom, aren't just going to keep their money in a jar underneath their mattress. They're going to invest it at market rates, which means they're all going to get a certain rate of return. They're all going to have more dollars in the future. This starts a chain reaction, which eventually leads to higher prices, and thus money buys less. Now keep in mind, this is a very simplistic way of explaining things. There's a billion other things that contribute to the valuation of money. But at least we wanted to start you on the right track.
Section F, a practical guide to the types of interest rates in the marketplace.
If you remember, at one point during the discussion of future value, I told you that we would come back to the subject of different types of interest rates in the marketplace. Well, now's the time.
Oh,
Don't stress. After annuities, it's a cakewalk.
First, there's the market or nominal rate. This is the rate that is inherent in the market and the rate that you were quoted by lenders or borrowers.
Neither a borrower nor a lender be.
However, the nominal rate only gives you a general picture of what the interest will add up to. As we have seen, compounding is the key to figuring out the value of what you will actually owe or receive. The nominal rate is often accompanied by the number of compounding periods per year. They're good friends.
The annual percentage rate, or APR, is another interest rate term which many of us are too familiar with. This is the term most frequently used with credit cards. It is merely another way of saying the nominal annual interest rate.
Another commonly used rate is the periodic rate. This is the interest rate actually paid per compounding period. In essence, it is the nominal rate divided by the number of compounding periods per year. For a $1,000 loan with a 10% nominal rate compounded semi-annually, the periodic rate would be 5%.
The most important rate to know is the effective annual rate, or EAR. Yes, we know that spells year. This is the interest rate that you will actually end up paying on a loan or a credit card. The formula for EAR is a little confusing, but if you want to be certain about what your total interest rate will be in a year, this is your equation.
EAR is equal to 1 plus the nominal rate, I, over the number of compounding periods, M, raised to the power of the number of compounding periods per year, again M, quantity minus 1. So, a credit card charging 2% interest
Oh,
a month,
man.
or a nominal rate of 24%. EAR is equal to 1 plus the nominal rate, I, over the number of compounding periods, M, raised to the power of the number of compounding periods per year, again M, quantity minus 1. So, a credit card charging 2% interest a month, or a nominal rate of 24% a year, would work out like this. EAR equals 1 plus 0.24 over 12 to the 12th power, quantity minus 1. Follow the formula. 1 plus the nominal rate of 24% divided by the number of compounding periods per year, 12, because it's monthly. That equals 1 plus 0.02, or 1.02. So, 1.02 raised to the 12th power for the number of compounding periods minus 1.0 would equal 0.26824, or almost 27% a year. The credit card company may tell you 2% a month, but that compounding interest nails you with a 27% interest rate per year.
Oh, that stings!
You must use the EAR to truly determine an annual rate.
Section G, compounding, the master formula.
Something else should be noted. There is one single equation that will allow you to determine the future value of an investment, no matter how many compounding periods you have. You can use this one equation to figure out the future value of the investment, whether the interest is compounded annually, just once, or daily, 365 times a year.
I'm sorry to have to say it, but the time has come to let you in on one of the sad facts of life. Often, there are much easier ways to do things that we, the academic community, don't teach you right away. We would much rather have you learn the hard way first. I'm sorry, but it's in our contracts. So learn all the equations here, even the redundant ones, because you're going to be tested on all of them.
Getting back to our point, you can use the master equation for compounding interest to determine future value, regardless of the number of periods.
FV is equal to the present value times 1 plus the nominal rate over the number of periods per year to the power of the number of periods per year times the number of years.
An example would be a quarterly compounded security which cost you $500 with a nominal interest rate of 10%. You will hold this investment for 10 years. Plug in the numbers.
The future value is equal to $500, the initial investment, times 1 plus 0.10, the interest rate, over 4, the number of periods per year, to the power of 4 times 10, which is the period per year times the number of years. 500 times 1.025 to the power of 40. 500 times 2.68506. The future value of this investment is equal to $1,342.53.
See, it does work. I can detect the suspicion disappearing from your faces already. Remember, you can use this last formula to give you the future value on an investment no matter how many compounding periods you have. You just need to plug in the right numbers.
Section H. Other important concepts. Other concepts like justice, beauty, and the relativity of time and space.
We meant other concepts in the field of finance.
So say you're in a retail business, and like most other retailers, your cash flows are a little, how shall we say, irregular. How do you figure out the future value of your earnings? If you have a good projection of your intake, how do you figure out what it's worth right now?
Ask an accountant?
You got it. We have formulas. To find the future value of an uneven cash flow, we use a version of the future value formula. However, every cash payment is figured differently, with its own period. Then those are all totaled. Confused? Watch.
In the next 4 years, I'm getting payments of $200, $300, $500, and $600. The interest rate is 8%. So for each part of the equation, we find the FVIF, you know, the future value interest factor, by cross-referencing the interest rate, 8%, and the number of periods, which changes depending on how long the money has been in the bank. So the $200 is 8% for 3 periods, the $300 is 8% for 2, and the $500 is for 1 period, and the $600 isn't compounded. Why not? These are cash flow payments, which happen at the end of the year. The last payment doesn't have a chance to get compounded before getting to you. Once you get all these figures, add them all together. Watch. All of the payments times their respective FVIFs totaled. Your final answer is $1,741.80, in case you're interested.
What we're basically doing is going back and calculating the future value the long way. With different payments, you can't just future value interest factor once for all of the cash flows. You must apply them to each payment separately, according to the payment's period.
We have learned present and future value. Now, on to conquer other topics.
Part 3, Basic Financial Concepts. Aw, that's a good fishy.
Section A. Risk.
Financially speaking, risk is the difference between expected and actuals. What does that mean? It means that financial risk is the risk that you won't get the return you're expecting.
Every action poses some type of risk. Every investment includes some type of risk. Even government bonds, which should be infallible, have risk. I mean, who knows if your dog might eat them when you're not looking? Investors try their best to minimize risk while maximizing the rate of return.
Risk aversion is the term used to describe a dislike for risk. Some people are more risk averse than others, which means they are less willing to take a risk and will most likely require a greater rate of return for that risk. Those who are indifferent to risk are called risk neutral. Those who seek out risk are called risk takers.
This is a risk taker. This is a risk neutral. This is a risk-averse guy.
Virtually all investments include some form of risk. Government securities are the only securities considered to be risk-free.
In the case of a stock, you are making an investment with no guaranteed return. You do not have a fixed rate of return. You don't know what you will receive back from your investment day to day. But you can determine the expected rate of return for a security, your best estimate, in order to make a better judgment on the worth of an investment. We have an equation to figure out the expected rate of return that's slicker than snot on a doorknob.
We will cover the expected rate of return soon. But before we show you the equation for expected rate of return, we need to talk about probability distribution.
Probability? Yay! Rate of return? Triple yay!
Probability is just a fancy way of saying chance. There's a chance that I could get sick today. It may not be a good chance because I feel healthy. So you could say a 10% chance. However, there is little or no chance that I will give birth right now because it's not possible. 0.000001 is the probability of me giving birth.
Get it out! Look what you did to me! Look what you did to me! I hate you!
When you list all possible outcomes for a situation, and then list the chance that they will occur, that's a probability distribution. Once again, a probability distribution is a listing of all possible outcomes and the probability associated with each.
It's a beautiful baby.
You must translate this distribution table to a more usable form in order to figure out the expected rate of return. The finance student must look at all the possible outcomes for the investment based on the probability of those outcomes taking place. That, in essence, is the expected rate of return. It is a weighted average of all possible returns on an investment, with the weight being the probability of each return occurring.
Let me say it again. The expected rate of return is a weighted average of all possible returns, or outcomes of an investment, with the weight being the probability of each outcome occurring. R.
For instance, our chosen investment is a company called Nuggets. They are producers of the colored deodorizer discs put at the bottom of urinals, which they refer to as Nuggets.
I thought they were called mints. Well, somebody's gotta make them.
Let's ascertain an expected rate of return for this wonderful company called Nuggets.
There are three possibilities for the economy: a boom, which is high economic activity, a normal period, or a recession, which is low economic activity. Each, as you can see from the chart, has its own probability of occurring. For the purposes of this example, we made the probabilities up. Your professors will make up different ones for you.
In a boom period, Americans are doing well, so they are drinking more, which means they are using the bathroom more, which means more nuggets!
However, as you can see from the chart, in a normal period, there is less fluid intake by Americans, so fewer nuggets are being used. And in a recession, even less fluid intake, so even fewer nuggets. You can derive what the probable outcome would be for a company like Nuggets based on the expected states of the economy.
So to figure out the expected rate of return on an investment in Nuggets Inc., you must complete the following formula. You must multiply each condition by the probability of that condition occurring. Let's sound mathematical. K sub S, the symbol which we will use for expected rate of return on Nugget stock, is equal to the sum of the probability for each outcome multiplied by the outcome itself.
Taking our Nugget example in boom economy, which has a 20% chance of occurring, the return on Nugget stock is pouring in at 20%, and in a normal period at a 60% chance of occurring, the return is trickling in at 10%, and in a recession at a 20% chance of occurring, the return is bad at 0. So, take each probability and multiply it by its probable outcome and then add it all up. 0.20 times 0.20 equals 0.04. 0.60 times 0.10 equals 0.06. 0.20 times 0 equals 0. Add up all three, and you get an expected rate of return for nuggets of 0.10 or 10%.
Although there may be a point in time where the economy is actually at one of the three states, the economy is in constant flux. So put these 3 points on a graph, plotting the probability of the state of the economy on the y-axis and the rate of return or outcome for that probability on the x-axis. After plotting this, you can draw the curve of the continuous probability distribution, which should look like a bell curve. This graph shows the pattern of the rate of return in the transition periods from boom to recession. This curve is significant because it also demonstrates a major point with the rate of return.
Time for the point.
Two companies could have the same expected rate of return, but one could be a better investment than the other. Why? Because one might have less variation in the possible rates of return during different states of the economy.
In other words, our company, Nuggets, has a decent total expected rate of return. However, it also has a chance of the return being 0. The possible returns fluctuate greatly along the x-axis of our graph, because the state of economy affects Nuggets' profits dramatically. Our earlier example, naked trampolining, has even a greater variation on rate of return. Probably because people can't afford luxuries such as naked bouncing fun unless there's a big boom. However, if you look at the next example, H2O Co., a public water utility, there's much less variation because folks need water regardless, boom, recession, or what have you. So you can state that the more peaked the probability distribution graph, or the narrower the distribution of return, the better the chance that the investment will pay the expected rate of return. Consequently, the more peaked and less wide the probability distribution, the less risky the stock.
All these examples are confusing me. What are you trying to say?
Well, we can summarize this with a sentence. The wider the expected return distribution is, the more risky the stock is.
That's it?
That's it.
Well, what was all that other stuff?
Just other things you may need to know how to do. You know, all the other ways to say the same thing. You most probably need to know it all.
Section C, risk and standard deviation. Hey, don't touch the cards.
Now that we have discussed probability and risk in general, let's talk about how to measure risk.
You can't measure risk.
Sure you can, with standard deviation.
We're going to measure the risk inherent in crossing this freeway by making one of the standard deviants try it. If he gets squashed, we know it's risky.
Or we could use the mathematical form of standard deviation. This is a concept that haunts finance students throughout the semester. It's difficult to explain and often not explained very well. Plain and simple, standard deviation is the statistical measurement of risk. Standard deviation simply measures the difference between the expected return and the actual return, which, as we stated earlier, is the definition of risk. Don't try to understand where all the specifics of standard deviation come from. That's something statisticians do. You just need to use it.
As we explained before, the more narrow the probability distribution, the less risky the investment. The standard deviation is a statistical measurement of the narrowness of the probability distribution. It's just a way for statisticians and financial managers to come up with a measurement of risk. The smaller the standard deviation, the narrower the probability distribution, the lower the risk.
Another way to think of the standard deviation is as a measurement of variability of possible returns. The higher the standard deviation, the greater the variation of the stock's performance and the higher the risk. Of our earlier examples, naked trampolining would have the highest standard deviation because it had greater variability and a wider probability distribution. H2O Co. had the lowest standard deviation, and thus the least wide probability distribution and the least risk.
Now, let's show you the formula for standard deviation, which you will use often. The symbol for standard deviation is sigma. Sigma equals the square root of the sum of all of the differences between expected and actual outcomes squared, each multiplied by their respective probability. Sound confusing? Well, there's no good way to say it, so just watch. You will also need to look back at our urinal nugget company because we will use the numbers for this example.
Just plug in the numbers from our nugget example as we go along. First, we'll figure out the differences, then multiply them by their probabilities. Once we get those three, we'll sum them and go on from there. Remember now, Nugget's expected rate of return was 10%.
So, in a boom economy, the Nugget Company has an actual return of 20%. 20% minus the expected return of 10% is 10. Square that, and we get 100. Write that down. In a normal period, Nuggets showed a 10% return. 10 minus the expected return of 10 equals 0. 0 squared is 0. Write that down. In a recession, the company showed a return of negative 0%. 0 minus 10 is negative 10. Negative 10 squared is 100. Again, write that down.
Take a deep breath. So now you have three totals, one for each possible outcome. Following the formula, you take each of these and multiply it by the probability of that state occurring. For boom, 100 times 20% chance of occurring equals 20. For normal, 0 times 60% chance of occurring equals 0. And for recession, 100 times 20% chance of occurring equals 20. Now you take those final numbers and add them up. This is the sum of the differences squared times their probability. When we take the square root of this number, we'll get the standard deviation. Incidentally, this number, which in our case is 40, for no apparent reason is given a name. It's called the variance.
Continuing with the formula, only one step remains, the square root. So you square root 40 and come out with 6.32. Call that puppy a percent and you got yourself an answer. The standard deviation of Nuggets is 6.32%.
Keep the standard deviation formula, and remember, K sub I is the actual outcome for a condition. K hat is the expected outcome, and P sub I is the probability of a certain condition occurring. If you remember that, you should be A-OK.
So now you know how to determine the standard deviation, the primary way to measure risk in an individual investment. Aren't you excited?
Another dandy formula which is critical to the finance student is the coefficient of variation. With the coefficient of variation, you standardize risk. What does that mean, you ask?
It means that you find out how many units of risk you have per unit of return.
Unit of risk? What the hell is a unit of risk?
Yeah.
Okay, well, you know how the smallest part of anything is an atom?
Okay.
So the smallest part of a risk is a unit.
Really?
No, what units really means is we used some equation to make it so we could compare all risks and all variation.
The coefficient of variation takes the standard deviation and divides it by the expected rate of return in order to measure risk per unit of return. Simply put, it's like putting a magnifying glass on the standard deviation to focus more clearly on the differences between two investments.
The coefficient of variation is an excellent means of comparing two investments, especially if you're comparing two investments when it's not an obvious choice which is more risky. The lower the coefficient, the better. You could also call the coefficient of variation the risk-return trade-off because it measures the amount of risk per amount of return of your investment.
The coefficient of variation is not a percentage like the standard deviation. It is a number. The higher the coefficient of variation, the riskier the project.
For our nuggets example, to figure out the coefficient of variation, you take the standard deviation, or 6.32%, and divide it by the expected rate of return, or 10%, and come out with a coefficient of variation of 0.632.
Let's compare that to naked trampolining. The standard deviation for naked trampolining was 52.50%. It is higher than Nuggets because, as discussed before, this company has a worse probability distribution. The distribution is wider. However, the expected rate of return, which is 25%, is higher because when people do buy these trampolines with baby oil, the company makes an excellent return on each unit sold. High profits. So, the rate of return is 25%.
Naked trampolining's coefficient of variation would be its standard deviation of 52.50% divided by its rate of return of 25%. This equals 2.1.
Remember, we created these numbers for the sake of comparing nuggets to naked trampolining.
Comparing Nugget's coefficient of variation with naked trampolining's enables you to pinpoint which investment is less risky per unit or percentage point of return.
Naked trampolining has a higher rate of return than nuggets, but it also has a higher standard deviation. The coefficient of variation of naked trampolining is 2.1 versus the 0.632 of nuggets. Thus, naked trampolining is riskier than nuggets per unit of return. The coefficient of variation allows the investor to pinpoint exactly which investment is less risky per unit of return. It appears that there are a lot of risks associated with naked trampolining.
Give me your wallet!
Up to this point, we have focused on assessing the risk of individual stocks. There are two measurements of risk for individual stock investments: standard deviation, which is the most basic statistical measurement of risk, and the coefficient of variation, which measures risk per unit of return. They are both important to finance.
But what about the risk of groupings of stocks? How is an investor's risk affected when he or she purchases more than one stock? Oh, I need answers, man! Answer me!
Hold your horses!
Wilbur, I want some oats.
Ha ha ha. Guess what? We're not going to tell you yet. If you want to find out about what happens when you buy more than one stock, you got to buy part 2. Here, look at this.
Okay then, in this video we covered many subjects. We started with some basic terms and concepts like the role of the financial manager, the types of businesses, the types of financial statements, some basic accounting, and interest rates. We then moved on to the time value of money, including present value, future value, annuities, perpetuities, and compounding interest. From there we talked about risk and rates of return, standard deviation, and coefficient of variation. What a trip!
This isn't quite what I expected.
Another thing you might want to pay attention to is Insert Card 2. On here, we give you quick and easy directions on how to use a financial calculator. Using a good, solid financial calculator will make your life as a business student much easier. Most students don't know how to use them. Heck, you can probably even bring them into your classroom and into your exam period. And a special hint? You're going to need a financial calculator if you get to our second tape, The Wild and Wacky World of Finance Part 2.
Stay tuned for the second part to our finance class. Our second video, The Wild and Wacky World of Finance Part 2, will offer more than the basics in finance. In this upcoming video, we will examine portfolios, stock and bond valuation, and much more. Look for Finance 2 in your bookstores.
Thanks for watching, and look for more video course reviews with the Standard Deviants! Bye-bye. Bye-bye. Bye-bye.